Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we'll explore how companies can unlock value for shareholders through a process called dividend recapitalization, especially before a final strategic sale of the business. Essentially, this involves increasing the company's debt to pay a special dividend back to shareholders, which allows them to receive returns without selling their shares outright. This strategy can help shareholders capture some immediate value while setting the stage for the eventual sale. Throughout the presentation, we'll break down how this works, the benefits and risks involved, and why it might be an attractive option depending on the company's financial position and market conditions. Let's begin with a clear understanding of the core concept and its role in strategic financial planning. Many founders and private owners see liquidity as something to be realized only at the end, after selling the business. But if the company is already generating consistent surplus cash flow, waiting several years for a final sale to unlock value actually increases risk rather than reduces it. By postponing payouts, owners are concentrating their exposure in one place, compounding that risk without changing their position. Dividend recapitalization challenges this approach by allowing owners to extract value earlier, providing liquidity without needing to wait for a full sale. This strategy helps manage and spread risk more effectively while still preserving the long-term value of the business. Rather than leaving all your wealth tied up in the business and hoping market conditions stay favorable until you sell, you can strategically access liquidity now. This works by refinancing the company's balance sheet, which allows you to pull capital out while still keeping control of the business and benefiting from its future growth. When done right, a dividend recapitalization isn't just financial manipulation. It's a careful way to reduce risk by turning some of that potential value on paper into real cash in hand, without giving up the potential for a premium when you finally sell. This approach is used by experienced owners and private equity firms because it balances getting liquidity today with preserving long-term upside. We'll walk through how this works, how to do it safely, explore some real examples, and weigh the key advantages and disadvantages so every shareholder can make an informed decision before taking cash off the table. A dividend recapitalization happens when a company takes on new debt, usually in the form of senior secured loans, and uses that money to pay a special dividend to its shareholders. It's important to understand that the business itself isn't sold, and the ownership or control of the company doesn't change. Instead, the company adds debt based on its reliable cash flows, allowing shareholders to get liquidity right away. Essentially, this process lets owners access part of the company's value early without triggering any change of control or restricting their strategic options. While this strategy has been common among private equity firms for many years, it's now gaining traction with founder-led and family-owned businesses, especially when they have strong cash flows but aren't ready or sure about a full sale of the company. This way, shareholders can benefit financially without giving up control. Dividend recapitalization offers significant benefits by reducing the risk tied to having wealth concentrated in a single business asset, allowing the founder or shareholder to convert some of that wealth into diversified liquid capital while still focusing on growth. It also provides liquidity without forcing any strategic changes or surrendering control, meaning owners keep their authority and direction without external pressures like imposed integration or culture shifts. Lastly, it grants shareholders flexibility when considering a final sale, since they can use the extracted capital to wait for better offers, reject less favorable ones, and choose the optimal market timing, which ultimately enhances their negotiating power. When considering dividend recapitalization, the key factor is the durability of cash flow rather than optimistic projections. Lenders look closely at how stable EBITDA margins are, ensuring that earnings remain consistent. They prefer businesses with contracted or recurring revenues, as this provides more predictability. It's also important that the company's customer base is diverse enough to avoid dependency on a few clients, and that the business operates in an industry that is relatively defensive or less sensitive to economic swings. Cash flow tends to be cyclical or unpredictable, then the leverage for the recapitalization needs to be lower to reduce risk, or it may be better to postpone the transaction until the business demonstrates greater financial stability. This careful validation step helps ensure that the recap makes sense and can be supported sustainably. When structuring the debt for a dividend recapitalization, it's important to be conservative rather than stretching leverage to the maximum just because lenders might accept it. Typically, senior debt falls within a range of 2 to 3.5 times EBITDA, and sometimes additional layers like mezzanine or unitranche debt are added, but caution is key. The main question isn't how much debt can be pushed on paper, but whether the business can comfortably manage its debt payments while still investing in growth and maintaining resilience during economic downturns. Extracting liquidity should never compromise the company's operational flexibility. This careful balance ensures the business remains strong and adaptable even after the recapitalization. Once the financing closes, the company pays out the proceeds as a special dividend directly to shareholders. This payout is typically done in a tax-efficient way, depending on the jurisdiction, so shareholders can receive cash without a heavy tax burden. Importantly, the ownership structure of the company doesn't change. No shares are sold or diluted during this process. It's also key to understand that this isn't the shareholders borrowing money personally. Instead, the business itself takes on the new debt and the company is responsible for servicing that leverage. This approach allows shareholders to access liquidity now while keeping their ownership intact. After completing the dividend recapitalization, it's essential to reset the company's operating strategy with strict discipline. Capital expenditures and working capital need to be carefully controlled to avoid unnecessary spending. Growth projects should be evaluated against higher return benchmarks because the cost of capital has effectively increased due to the new debt. Free cash flow should be focused primarily on paying down the debt rather than on other uses. The key to success here is treating the added leverage as a temporary tool to generate shareholder value, not as a permanent solution or crutch for ongoing financing needs. Disciplined approach ensures the company remains financially healthy and can sustain long-term growth. Dividend recapitalization is a common strategy used by private equity firms with their portfolio companies. During a typical holding period of 5 to 7 years, sponsors might execute one or more dividend recaps to return capital to investors early, while still maintaining equity in the business for the final sale. Approach shows that liquidity and long-term upside can coexist effectively. On the other hand, founder-owned infrastructure and service businesses, such as asset-light logistics or environmental services, increasingly adopt dividend recaps once they achieve scale and have recurring revenues. These businesses attract leverage because their cash flows are predictable, even if there's no immediate plan to exit the investment, highlighting how steady cash flow can support debt without sacrificing growth potential. In family-owned industrial groups, dividend recapitalizations play a key role during succession planning. They provide a way for retiring shareholders to access some liquidity without forcing the sale of the business. This means the next generation can continue running the company while still allowing senior family members to realize some of their investment. It's a helpful tool that supports smooth generational transitions, keeping control within the family and avoiding disruptions that often come with external sales or buyouts. Shows how recaps can be tailored not just for financial management, but also to preserve legacy and continuity in family businesses. A dividend recapitalization provides immediate liquidity to owners without them having to give up control of the business. It helps reduce personal financial concentration, meaning owners are not putting all their eggs in one basket. At the same time, they remain able to benefit from future growth and upside potential of the company. This move also strengthens their negotiating position when it comes time to sell the business, since they've already taken some returns off the table. Depending on how the recap is structured, it can be a tax-efficient way to extract capital. Beyond the numbers, many owners find a psychological boost simply from knowing they have already realized some gains, which can be a significant and positive shift in mindset. Dividend recapitalizations can be very effective, but they do carry some important risks. Increasing leverage means less room for error, so if business conditions worsen, the company might face tough operational choices. Lenders often include covenants that limit what a business can do. They might restrict acquisitions, equity distributions, or shifts in strategy. Another risk is how the transaction is perceived. Potential buyers might see an aggressive recap as shareholders taking money out at the cost of reinvesting in the business, unless the company performs well afterward. Finally, when shareholders reduce their risk too much, it's crucial to align management incentives carefully to avoid complacency. Essentially, a dividend recap either strengthens operational discipline or reveals its absence. When comparing dividend recapitalization with selling early, the key difference lies in the balance between liquidity and control. Selling early provides high liquidity, but at the cost of giving up control and future upside. A minority sale offers medium liquidity with shared control and some upside, but it's often a partial solution. Dividend recapitalization, however, allows you to unlock a significant portion of liquidity while maintaining full control of the company and retaining the potential for full upside. This strategy lets you access cash without selling ownership, which can be especially beneficial when you want to manage risk, but still participate in the company's future growth. Essentially, dividend recaps sit strategically between these other options, offering a unique mix of benefits that can align well with long-term plans. A dividend recapitalization works best when the company has stable and reliable cash flows that can support additional debt. It's ideal in situations where growth doesn't demand constant heavy reinvestment, allowing owners to take some money out without sacrificing their control or the business's future potential. This approach suits owners who want liquidity but aren't ready to fully exit, especially when the timing for a strategic sale is uncertain. It also helps shareholders manage and reduce their personal financial risk. However, this strategy isn't a good fit for early stage companies, turnaround situations, or businesses with highly cyclical earnings, since their cash flows aren't predictable enough to handle increased leverage safely. Dividend recapitalization is often misunderstood as a move driven by greed or an attempt to squeeze every last penny, but it's really about making smart, informed choices. By adding senior debt against proven steady cash flows, business owners can unlock substantial value today rather than leaving everything to chance with a future sale. This approach reduces the risk for equity holders while keeping control firmly in their hands, maintaining strategic options, and allowing them to benefit from a potential premium when the business is eventually sold. Essentially, you don't need to sell a strong business to realize its value. A carefully planned dividend recap lets you convert past success into certainty and liquidity, one step at a time, all while leaving room for an even more rewarding exit in the future. It's about turning time into an asset rather than a risk. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.